Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today's Thursday. It's October 20th. Before I begin, I want to thank you for watching these videos. I want to really thank you for subscribing to these videos. And I want to thank you 3 times for commenting below these videos on our WealthPress YouTube channel, because I actually respond to all of them and I use them for ideas for my other videos. So please post your comment. Now, it's about 8:20. The market's going to open up in about an hour and 10 minutes to be specific with you. And the market's kind of mixed right now. The 100 points on the Dow is not really significant. NASDAQ is kind of flat. Earnings are being absorbed right now like there's no tomorrow. As a matter of fact, let me give you guys a full earnings summary. This will give you the best earnings summary you'll be able to find, and it encompasses everything we've been or seen so far. So we've had 62 S&P members report so far. Total earnings are down 4.6% from the same period a year ago on 8.8% higher revenue. 77% have beaten earnings per share, and 59 have beaten estimates. Now, does that mean things are good? No. It just means that the numbers have been beaten down so much that they're outperforming, which is giving the stock market a little artificial boost. But again, it doesn't mean the numbers are good. The numbers are actually really bad. But again, Tesla was expecting to go down negative 46%, Netflix down 36, 38%. So the fact that you have such a big proportion of stocks beating EPS doesn't really mean anything too significant other than the fact that the numbers have been beaten down so much. And we saw the exact same thing last quarter. With respect to positive surprises, 62 members so far, and remember, it's pretty early so far. Estimates is below the 5-year average, but otherwise within the historic range. And revenue beat percentages is on the lower side. Now, looking at the third quarter as a whole, total earnings are expected to be up 0.6%. Ouch. From the same period last year on 9.1% higher revenue, 0.6%. Now, excluding energy sector, here's where things get really dirty. They're looking at 6% negative from last year. So energy is really overcoming the burden of higher proportion stocks making better. Or basically, energy is making us look a lot better than we're looking. And the negative revisions, or the negative revisions down by the companies themselves or by analysts. The ongoing season appears to replay what we witnessed the last quarter, when estimates and sentiment has weakened so much that the actual results ended up looking a lot better in comparison. There we go. That's kind of what I was just trying to say. I actually didn't read that beforehand. Now, having seen results from about 12% of the S&P members, we could see that the results are not bad, but they're not really great. Now, what to expect today? We've got a lot of stuff on the table. You've got Alaskan Airlines, American Airlines, Blackstone, that's a big one right there. Boston Beer, CSX, Dow. I mean, you name it, we got it, right? Nucor Metal Company, and they're doing pretty good right now. STLD came out yesterday. They beat expectations. Philip Morris, Quest Diagnostics, that's an interesting one. Whirlpool, always interesting. Union Pacific. So, and then tomorrow, we don't have a big day tomorrow. We have Verizon and Schlumberger and HCA. But what we do have is American Express, and American Express is really, really important because it gives us a reflection of how the businesses are taking on credit and whether businesses are paying credit off. They're actually looking very, very well. And again, Warren Buffett company. High profit margin, folks, $2.42, 6.6% over, and revenue 28% over. I mean, it's by no chance great, but it's better than negative 6%, right? I like this number. Hopefully we'll see upside from Friday. But again, there's a lot of earnings, and I'll give you a full update probably next Monday if I had to guess. We only have 62 stocks, so we only have like about 11, 12%. We need to see a little more to get a final picture, but so far, things are looking exactly like they looked last quarter when things were beaten down and they got slightly better upside. Now, what I'm really concerned about, and I haven't talked about this in a few days, is the bond market. If you look at the bond market, it's been going straight down. It's have taken on this trend again after the see and wait pattern. This is really concerning me on one hand, and I'll tell you why. Because if the bond market's going lower, that means the odds are tech and consumer stocks are going to be going lower. But and this is one of the reasons why I'm not trying to trade the bottom and trade it to the upside. I'm only trading taking trades to the short side. And right now, it has a lot more to go upside. Notice it didn't really bounce too much beyond this, and I was thinking it was going to go a lot higher. So we missed that opportunity, but if it rallies again, maybe to the 110, 115 level, I will short it. I'm willing to short it, but I'm not going to go against the trend. This is disturbing, but what I'm liking about this is this. If you look at ARK funds, if you look at Kathy's stocks, look at this. I mean, she didn't really break down by that much, right? I mean, just a little hair here, but now we're back in its range. And if you look at IWM, the Russell 2000, it also is now looking higher. And look at the mid cap. So the fact that stocks are completely not moving in the same direction as the bond market is very, very promising. It's actually telling me that the stocks may be in a position right now to shrug off higher rates, and that's a very, very, very bullish sign. Another bullish sign that I'm seeing right now is the fact that we're actually coming off of these levels, and one sector that's starting to do really well is the industrial sector. The industrial sector is starting to heat up. Matter of fact, if you look at my sectors right here, you will see that industrial stocks are right here, second behind healthcare. And industrial stocks usually don't do really well in a recession. So the fact that they're rising, but it is sort of defensive. It's not, I mean, it's obviously not communication services, technology, or consumer discretionary. There's not that much interest rate fluctuation there. But the fact that industrial stocks are moving higher is a positive sign, and it's telling us that the world may be preparing to get out of this recession, not into it. Now, let's talk a little bit about global economy, and then we'll get into the nitty-gritty, shall we? A lot of things here to talk about as well. So, futures are down just a little bit. The biggest losers are in the financial, healthcare, and utility sector. And these are neutral sectors. They're not inflationary or deflationary. They're actually fairly neutral. If anything, they tend to like inflation because utilities the cost gets passed on. Healthcare is not a big deal, and interest rates go higher when we have an inflationary pressure. So the fact that they're going down is also kind of interesting, and also tells us that we may be getting out of this, not getting deeper into it. The yield on the 10-year Treasury note touched its highest level in more than 14 years. This is really bothering me after U.S. home builders fell more than expected in September. Soft housing data failed to alter expectations that the Federal Reserve would remain aggressive. And they're going to be aggressive. As a matter of fact, 92.7% chance of a 75 basis point rate hike and a 7.3% of a 100. Now, the 100-point rate hike chance was actually about 2-3% a few days ago. On a positive side, third quarter profit expectations for the S&P advanced to 3% compared to 2.8%. The fact that it's moving higher is good, but look at where it was in July, 11.1%. Now, folks, this is a number that you want to write down. If this number keeps moving higher, that's a very, very positive sign over the next 2 weeks especially. If this 3% number keeps going down, it's a very negative sign. All eyes are on the jobless claims. The number comes out in about 2 minutes. I probably will have that number for you before we're done today. But the number was in the lower 200s, and now it's in the 228s, 230s. So it'll be interesting to see where it goes, and I'll look at it in just a few minutes if we're still here during that time. Also, Philadelphia Manufacturing Index, which was negative 9.9 in September. They're looking for a forecast at -5, which would make it better. And then existing home sales data comes out today as well. And I'm not expecting anything major there. They're looking for 4.7 million versus 4.8 million. And we'll get that news in a bit. German September PPI came in at 2.3% and 45% year over year, stronger than expected, which is positive. Chinese Shanghai today closed lower, but more hopes of stimulus is taking place, and they're keeping their rate at 3.65, which is fueling expectations for more monetary stimulus. Earnings today, as I mentioned, we got Alcoa, you got International Business. Tesla already came out, and they're down right now. As a matter of fact, let's take a look and see if they are in fact down. Let's see how Tesla's doing right now. I just can't type in the morning, right? Yeah, it's down about 5%. Yeah, it's not looking so much for Elon Musk surprising investors. But volatility looks like it has peaked. Some sectors are starting to come up, and momentum levels, as I'll show you right now in a minute, is starting to go up just a little bit. It's starting to strengthen. There it is right there. And as you can see here, we're really, really low. I'm hoping that these numbers will come up on a short-term momentum basis. There's plenty of upside potential for the stock market because look at where we're at. We're just starting to go through here. And usually when we're down this low, we go higher. So I am expecting stocks to trade higher over the near term. And another interesting thing, as you will see here, let's look at our levels. I want to give you some levels here. I like the fact that we're in this range. Let's take a look real quick. So we're kind of hovering right in this level. I'm hoping that we're going to stay above 30,000 on the Dow. And the resistance right now is at 31,000. On the SPY, we obviously look at the SPY. Our resistance on the SPY actually is at 379. 379. And on the QQQ, and the fact that we're in this range is really positive right now. And on the QQQ, love to see us go above this range, which is kind of sitting there right now. This is because of the bond market. The bond market's causing a lot more pressure on this. Notice it's the furthest away from this line. The area there we want to see at this point, I'll take 278 at this point. Now, let's take a look. Let's take a look. And by the way, I wanted to show you something else. A lot of people ask me for this. The 20-day breakout versus 20-day breakdowns, there's nothing there. There's no major buildup in momentum to the upside or downside, which means the markets can really, really move from the current levels. Now, let's go to Econo, and let's see if we could spy on the employment report and see if we can get some data on it. So let's see jobless claims. Let's see if it's moving higher. If it's moving to 240, 250, then the Fed may say, hey, there's too much unemployment. We have to cool interest rates. So it may be where bad news is positive. But if it's going lower, then the Fed will more likely than not continue their shenanigans. Oh, look at that. Look at that. It's actually back in line. So the Fed will say, hey, there's not unemployment problems. Our higher rates are not causing people to lose jobs or struggle. Employers are not struggling, laying off people. The number's actually pretty good. We were looking at 235. We got 214. The 4-week moving, we're just like 3,000 or 2,500 above the, or 3,500 above the 2,500, excuse me, above the 4-week moving average, which is not significant. So the number is a nothing burger. Philadelphia Manufacturing Index, let's see if that's out. And then I'm going to give you my ETF, the top ETF. Let's see if this number's out. It'll be very, very interesting. And while it's doing this, I'll move on to the ETF and then we'll come back to it. So as I showed you earlier today, we have the 11 sectors. I honestly would stay with energy, industrial, or healthcare. And industrial is interesting. So why don't we take a look at industrial? Let's see how much upside it has potentially. Yeah, I like industrial, and I like how it's breaking out right now. But do we want to take a chance, or do we want a sure thing? See, it's too overbought right now, the energy, and I think it's going to cool off. I would actually probably, if I were you, I'd go with industrial. Let's go with industrial. XLI. Let's go with the industrial. It's breaking out nicely. It'll probably go up to about the 93 level. Let's see here. We want to go to January. And we want to go with something around the 90. The bid is 150. They're all over the place right now, but there's open interest on it. Last was like 360. So you'll pay about $354. But 90 strike price, we're at 88. 90 strike price, plenty of open interest, plenty of liquidity. Go with the 90 and you'll do okay. Now, ooh, look at that. Negative 8.7, even below 9. This is good. These are positive numbers. Let's see if the market's responding. Yes. All right, I like it. And I'm glad you guys saw this in real time. See how sometimes the analysis works and everything works out? Folks, all signs are pointing to a global energy crisis headed our way this coming winter. Now, oil demand is high, but supply is dangerously low. Despite all the doom and gloom, Joy of the Trade, Jeff Zananeri, he's identified a potential opportunity amidst this growing energy crisis. You can get the details right now by clicking the link below. Folks, Even Warren Buffett agrees. It's a generational opportunity for intelligent investors. I think you'll agree once you hear what Jeff has to say. And Jeff has been right on the money with all of this. Follow along. Jeff has a really good sense for macro global economic data and how it impacts individual stocks. Highly, highly, highly recommend you follow this link and watch what he's got in store for you, especially in light of all this crazy volatility that we're seeing right now. You guys have a great day. Make sure to subscribe to this channel, like this video, comment below. I know who you are, and I'll talk to you later. Bye, guys. Have a great Thursday. See you soon. Bye.